In this video, we're going to discuss income-based repayment plans for federal student loans. So let's say that you just graduated college and you get a job making $2,000 a month, and after living expenses of $1,600 for the month, you have $400 left over. And you say, hey, great, I've got $400, I can pay my student loan. But then you get a bill in the mail from the government and says you owe $568, and you say, wow, that's $168 more than what I have left over. Don't worry, don't default on your loan. What you want to do is look into changing your plan type, right? So there are different types of repayment plans, and some of which are income-based, where they can say, hey, look, you're only bringing in $2,000 a month. Maybe you thought you'd be bringing in more given your amount of money that you've borrowed. So we're going to cut you a break and basically go off a percentage of your discretionary income. So I just want to give you a quick overview of the different plan types, and I'll explain a little bit more about how they work. So one plan type is called Pay As You Earn, PAYE. And so with Pay As You Earn, the maximum payment that you would ever have for a monthly payment is going to be 10% of your discretionary income. And you might say, well, what does discretionary income mean? Okay, well, before we said that we assumed that you made $2,000 in the month in income. Well, discretionary income, what they do is they subtract out whatever, it could be 100% of the poverty line, 150% of the poverty line. It's going to depend on which different plan type, and I don't want to get into that too much, but it's a percentage of the poverty line and for your family type, however many people are in your household. Let's just say, hypothetically, that for your family type that it would end up being $1,200. So $1,200 is subtracted, and then $800 would be your discretionary income after subtracting the percentage of the poverty line that applied to you. And so then the maximum that you would pay under this PAYE program you would pay 800 times 10%. These are just all hypothetical numbers. Don't take any of this as gospel. But in this case, it would be $80 a month that you'd be paying. Now, you might say, how would I ever pay off my student loans if I'm just paying $80 a month when I was really, under the standard plan, paying $568? There's no way I'm ever going to pay my balance. Well, the nice thing is about income-driven repayment plans is that the balance is forgiven after a certain point in time. So, in the case of a PAYE loan, after 25 years, whatever amount is left is forgiven. So that means, let's just say, for example, that you still owed $40,000 after 25 years. So what the government just says is, hey, look, well, you've been making your payments on time. We've forgiven that loan. You no longer owe $40,000 on your student loans. And you say, hey, that's great, but bear in mind that you may have to pay tax on that. Let's just say that the tax rate 25 years from now, your tax rate was 10%, then you would owe $4,000 in tax, because when you're forgiven a debt, that actually is counted as income to you. So this $40,000 would be counted as income. However, you're getting out of paying that $40,000. So there is a small price to pay with the tax. To qualify for this type of income-driven repayment plan, you do have to have high debt relative to your income. So you're in kind of a situation where it's financial hardship. You need to have a certain amount of loans and so forth. Not just anybody can get that. So what the government did in 2015, they actually wanted to expand this pay-as-you-earn program. So they come up with a revised pay-as-you-earn option now, and that's similar, although it's going to draw in a bigger pool of people that are going to be allowed to qualify for this. It basically allows people, if their monthly payment is higher than what it would be under just the standard repayment plan. So let's say before, remember the standard repayment in our example, our initial example is $568. Well, let's say that after doing the calculations, the percentage of discretionary income for revised pay-as-you-earn, whatever that percentage is for you, that it ends up being where your monthly payment is actually $600 at that first year, let's say, right? Because with all the income-driven repayment plans, every year they're going to recalculate based on what your earnings are that year, right? So it's going to be continuously updated. But let's say the first year it's $600, and you say, hey, that's actually higher than what it would be under just the standard repayment plan. So they will allow you, with the revised pay-as-you-earn, you can still actually get involved with this program, even in spite of that fact. So that's why it allows more people to get involved with the program. Now, income-based repayment, which you might have heard of the most, is very popular. IBR is basically your monthly payment is going to be, it could be 10%, could be 15% of your discretionary income. And again, you need to have high debt, some kind of financial hardship. Not just anybody can say, oh, I want the income-based repayment plan. And so if you are saying, well, look, I don't fall into that situation where I'm in some kind of financial hardship, fortunately, you'll be eligible for Income-contingent Repayment Program, whereas ICR, where it's the payment is the lesser of 20% of your discretionary income, so whatever that is, 20% of that, or the fixed payment over 12 years. So if you were doing this as a fixed payment, same payment every month for 12 years, what that would be to extinguish your loan. Calculate those two amounts, and then the lower of those two numbers, that's what it would be under the Income-contingent Repayment Program. Now, bear in mind that any borrower can do this, but you have to have a qualifying loan type. For example, the Parent Plus loan right now does not qualify as income-contingent repayment. Who knows? Maybe the federal government will change that next year. You should definitely go online and see for each of these different repayment types whether your specific loan type qualifies. Now, one drawback to income-contingent repayment is a thing called negative amortization, which is an awful thing from the perspective of a borrower. Let me just briefly explain to you what it is. So let's say that after doing the income-contingent repayment, you say, you know what, okay, it looks like my monthly payment is going to be $150 a month. And you say, hey, that's wonderful. I can afford that. I think I'm on easy street now. But then you find out that, hey, wait a minute. My interest that accrues on my loan every month is $275. So every month your loan is accruing $275. And so here's the problem. Even if you are diligent and you make every single payment on time and you're always paying this $150, what's happening? Well, let's look at the first. So let's say this is the first month. You make the payment of $150. The interest was $275. What happens? Your loan balance actually goes up. It goes up $125, right? So let's say that you owed $40,000 at the beginning of the month. Now you owe $40,125, and you say, hey, how can that be? How is that even possible that I made my payment and yet my loan balance went up? That's negative amortization. You're basically accruing so much interest on the loan, and you're not even paying your payment. Even though it's legal, you did the income contingent repayment, what you were supposed to do, you're not paying enough to even keep up with the interest that's accruing. So the loan is getting larger and larger. Now, you might say, hey, look, 25 years from now, this loan is going to be forgiven, and that's what I'm shooting for. So I'll just take the fact that my loan balance is getting larger and larger. I just want to make sure I can make my payment and not go into default. And if that's your strategy, that's your strategy, and I'm not going to argue with you. But bear in mind that if you ever come into a situation where for whatever reason you want to have that loan paid off, it's going to be growing larger and larger because of negative amortization. So that's really something you really want to be cautious and think about what you're doing with your repayment plan when you choose it. Now, as I mentioned, not all loan types are eligible for every single one of these different types of repayment plans. Like I said, Parent Plus plans and so forth are restricted for some of them. Also, if you have a Perkins loans, you need to contact your school and talk to them about repayment plans. Now, if you have a public, or if you're planning to do the Public Service Loan Forgiveness Program, right, where you work for a nonprofit or a school for several years, and basically after 10 years you have an opportunity to be able to get your debt forgiven. Like earlier than that, before it was like 25 years. That's just in general. But if you work for a nonprofit, there's different qualifications. You should go online and check just to be sure. But there's different organizations you can work for, and after 10 years, have your debt forgiven, right? So in those cases, if you're a social worker, you're a teacher, you're gonna try and take advantage of this program, then you almost certainly want to be doing an income-driven plan, because what that's going to do is it's going to decrease your monthly payment, Right? It's going to decrease your monthly payment. Now you might say, hey, that's going to if I reduce my monthly payment, I'm going to end up having to pay more interest, and it's going to take me longer to pay off the loan, and that would normally all make sense, except 10 years from now you're going to have the loan forgiven. So, but if you're going to have the loan forgiven in 10 years, you want to reduce your payment as much as possible. However, always remember that something could happen and you not be able to complete that 10-year requirement at whatever type of organization you're supposed to be at, and then you could be stuck with a really big loan balance. So be careful and just kind of weighing the pros and cons of all these things. And remember that even though that with the income-driven plans, you can change your student loan plan type at any time, right? Remember, the default is you just make a fixed payment for 10 years. It's the same payment every month. That's just the default that you put in. You can change it at any time, but you have to apply. And some of the income-driven plans, not only do you need to have that certain loan type, but for a couple of the ones that we talk about, income-based repayment and so forth, you need to have high debt or some kind of financial hardship to be able to qualify as well. So make sure that you qualify or that you're going to qualify before you bank on a certain repayment type.